All right. Good morning, everyone. Good afternoon. Welcome back to the Nebius quarterly review. We have here Sam, we have Manuel, we have Nate. Good morning to all of you. Good afternoon, Manuel, to you.
Thanks, man.
How's
Good
everyone
afternoon
doing?
so far. It's not afternoon actually. I had lunch at like
Lunchtime.
11:30 just to be here and like not worry about food. So yeah, you can call it.
I don't think you have to
Afternoon.
worry about food anyway.
Yeah, I mean, now I'll just order like a bunch of caviar or something like that.
Yeah, I'm doing well. Thanks for having me on. Tired, but also excited. This is a crazy earnings. But yeah, it's like 6 a.m. my time, so I'm a little waking up still.
Poor guy.
This guy, you're complaining that it's 6 a.m., dude. It's 4 a.m. over here. Like, what are you complaining?
Oh yeah, you're the
about?
West Coast. Oh yeah. Never mind.
Nah, it's all good.
Maybe
It's all good.
you're used to these hours with the kiddos.
So we
Yeah.
all have different time zones. It's crazy.
Yep.
Yes.
Not even the
So the
European
internet
ones have the same.
Yeah.
Yeah, even in Europe, we have different time zones.
I mean,
So
mostly
any early
Portugal.
thoughts?
I was
I mean-
blown away by the Microsoft. By the Meta contract. I don't think you guys expected that either.
No, I did not expect anything to be
Yeah.
announced this quarter.
Yeah.
Any sort of, especially
agree.
hyperscaler. I was expecting maybe a smaller AI labs or smaller clients, but not a
Yeah.
big hyperscaler deal.
They kind of slid in with that Cloudflare and Shopify. I believe
Yeah,
on the
they also
last
slid in
earnings.
Cursor. We got Cursor too, which is cool.
Oh,
That's a
interesting.
big one.
Yeah, Cursor and Black Forest.
Yeah, those are pretty big deals too. But yeah, when I woke up and saw 2.5 gigawatts versus 1, I thought I was seeing things differently. In the ARR guide, it's just insane. They raised their ARR guide by 60% in one quarter.
Mm-hmm.
These aren't small numbers either. I mean, we're talking $8 billion.
Yes, 600. I mean, it's $2 billion for a quarter, $666 million for a month. When you analyze this whole thing,
Yeah.
crazy.
Just, yeah, it's nuts. Trying to look at previous quarter too. To see if there's anything else.
I mean, the contracted connected power increase here is also very, very nice to see.
Yeah,
Yep.
for sure, dude.
There is a dilution event.
Also, I was just going to say they had a dilution event at the market. 15 million shares it was, or 25 million shares?
Up to 25 million, yeah.
Yeah, 25 million, yeah. Which
Up
makes
to
sense.
Yeah, I mean,
I feel like
they can use
we'll
that.
expect that even more over the next 18 months, probably, as they try and build out data centers. Because they also highlighted that they could only do $3 billion for 5 years because of how much they're sold out, and they just don't have any capacity.
Yeah.
And they highlighted that they just can't help Meta as much as they want, basically. So we'll see more dilution events over the next 18 months, I'm sure.
Yeah, plus, I mean, this is up to 25. They can choose whenever they do it. They want to do it in a dilution-sensitive way. So we'll see. Might be the reason why the stock might not move that much.
That's what I'm thinking too.
I mean, who cares at this?
I know.
If this is to move much quicker and get bigger contracts in the future, why not?
Yeah.
Yeah, I mean,
the stock right now is essentially flat, and I'm okay with that after earnings like this.
All right, we'll see how it goes on at the earnings. I don't think the earnings. Oh, actually, I don't know. The analysts are going to have some crazy questions now that I think about it, especially with the Meta deal.
I think they might lower like the ARR guidance for the end of this year, probably because of the timeline for New Jersey. Because they didn't include it in the shareholders letter, so I guess that's kind of saying it's not a reiteration, at least.
Yeah, was it 900 to 1.1 billion?
Yeah, 900 1.1.
But with that guidance for 2026, I mean, I don't think we care much because it's just a problem of capacity timeline. It was actually the thing I was most concerned about was like the data one delays with the New Jersey data center and the locations that they were supposed to announce in the US soon, and we don't know anything yet. But I mean, if they got it for these capacity, not in contracted power, but between 800 megawatts and 1 gigawatt in connected power, it's huge, because that includes the power itself. And they also said they're going to sign more data centers in Europe, like big ones. New expansion in the UK starting next quarter. So I mean, I guess these 2.5 gigawatts will be like spread globally across several places, and I would even say that we might expect a big location in the UK, like with, I would say probably over 100 megawatts or something like that, because I saw that they're also establishing an AI R&D hub in London, so they're probably betting big on UK as well. I guess they're being like well received with these new data centers, so that makes sense. And I mean, in the UK, there's not much competition when you compare it with the US. I mean, they were the first ones to deploy the Blackwell Ultra GPUs, so they're probably the leader by far in UK. I don't even think CoreWeave is in the UK, right?
A lot of the other players, CoreWeave, Iron, Cypher, they're all located in the US. Obviously, that's where most of the demand
but
is.
CoreWeave has global operations, right?
Yes.
I actually have to check.
Yeah, no, of course. I think they have one even in, I think maybe even in Spain, I believe.
Yeah, in Barcelona, I guess, something like that.
Yeah. But in UK,
oh, you're right.
Probably with N-Scale, maybe.
Yeah, maybe N-Scale or Lambda, I don't know. But I guess it's much less competitive than the US and still has very big demand.
Yeah, no, they have two data centers in the UK.
CoreWeave?
Yeah, based on the slides of yesterday's report. Yeah.
Okay.
Yeah, let's hope we don't hear anything with delays in here, because if they mention anything to do with delays, that will just send the stock crashing down like CoreWeave. So we'll see about that. I mean, also, I think today really depends on like macro. NASDAQ is down about 0.5% pre-market. So that could also have a lot to do with the stock price today, because I'm only commenting on price action because a lot of people are mentioning it here. But other than that, I mean, like, it's very similar to what happened with Iron, where the quarter was actually good. The earnings call was okay. It wasn't like the best, because analysts are always trying to decrypt like every single little thing that has to do with like the amount of liquidity that they're proposing, also the deals and everything. Like, because all these deals are being like, we're probably going to hear a lot of questions about the meta deal, and it always comes up to like the analysts are somewhat, I don't want to say they don't believe them, but they just sound skeptical a little bit on the terms of the deal. That's always just been like the overlying thing. But with this one, I think today's price action, it'll really just this thing is just like this the whole day. So fundamental wise, man, this is really good. This is what you like to see. You like to see that continued performance. I didn't expect the 2.5 gigawatts.
Yeah, and on the 2.5 gigawatts, it actually is more than 2.5 gigawatts. So just like the last few quarters, they do like greater than 1 gigawatt. Same thing here. They put greater than 2.5 gigawatts. And so I bet by the end of 2026, it gets raised, or mid 2026, it gets raised again. The fact that they're still selling out of capacity right now and demand is still just insane. Yeah, it's just, I mean, 2.5 action contracted power is just insane. I mean, I was not expecting that. That's for sure.
I saw now that there's something on the letter saying that they will share year-end 2025 guidance during the earnings call. So I guess they will likely say, "Oh, we're going to miss it because of Data One." Fucking Charles.
Too busy posting LinkedIn. Too busy posting on LinkedIn.
Lesson for life: don't trust the French guys.
I'm not going to disagree. We do have a question here from Chris. Question on this depreciation. Would them having HQ in Netherlands be why they are depreciating faster? He says that's because the corporation tax rate in Netherlands is 25%. So they're doing that in order to keep more.
I mean, it's a choice to to depreciate faster. They did it on purpose when they said that the midterm guidance for EBITDA margin was between 20 to 30%. They said that the conservative approach when it comes to depreciation, using 4 years compared to CoreWeave of 6 years. I guess it's not really because of the headquarters in Netherlands. I think it's really because they want to be conservative and like more realistic than, I mean, I wouldn't say more realistic. I mean, in fact, it's more realistic because 6 years it's stretching a bit, and not only CoreWeave. I think the hyperscalers also are doing the same, but it's different. It's different here because the hyperscalers use the GPUs for internal workloads, so it's not really the same as CoreWeave, which is renting them. So the useful life ends up not being exactly the same. That's why it's tricky to look at the bear case that Michael Burry yesterday posted. But yeah, I think it's not really because of the headquarters, but really because of the conservative approach that management is trying to use.
I'm reading the shareholder letter right now. It's so funny how they said that the only reason why it was $3 billion was because they're limiting capacity. Like, can you imagine if they were not, how much that deal would be? That's pretty freaking insane, man.
Yeah, I hope they say like how many like megawatts are included in that deal.
Yeah,
because it would be a good proxy to compare with the Microsoft one and see like how much dollars are we get, how many dollars are we getting per megawatt, to see like how did it evolve from the last contract, or I mean, hopefully it stayed at least the same or more or less around the same range, let's say.
It says here, over the next 3 months, we plan to deploy the capacity needed to service the agreement. Does that mean I guess that means they don't need to build anything new.
Yeah, it's probably not much capacity. That's why I was wondering if they're going to say, because I mean, $3 billion, it's not much, but if it's just like a small cluster, it's already like a very good deal in terms of dollars per megawatt. But I mean, it's impossible to say without knowing a bit more details.
Well, they also, like, the next 3 months, like, that's very quickly. So there's a good chance they're giving them compute that's already available, that's already there, and maybe because Zuckerberg like needed it that bad that they're willing to pay up for it. That could be it too. I mean, depending on like where it's located, because a lot of the other guys, like they're building the capacity. You know, there is some available, but they're currently building it. Nebius is one of the few that actually already has it on a whole cloud scale versus like just GPUs and stuff.
Right. Yeah, I'm trying to read through this shareholder letter too to see if there's anything else.
I mean,
there's so many stuff in here.
Yeah,
they did miss a little bit the revenue estimates for the quarter, which is probably why they might want to talk about the guidance during the earnings call and not just put something in the shareholder letter. So maybe there is a delay. We'll see about that. But at least here, even if there is a delay, at least we have like a huge number for 2026. We have another announcement here with Meta. Of course, let's see what the dollar per megawatt is going to be for that one. But I do say, similar to the Microsoft deal, the economics of this agreement are attractive and will help accelerate the growth of our AI cloud system even further in 2026 and beyond. So I would assume the terms are similar. Might not be as good as the Microsoft deal, but if it's similar, I think we're in good hands.
Yeah, and if it's the capacity is planned to be out over the next 3 months, it should be like a co-location somewhere.
Yeah.
I mean, I'm not sure, but probably the the fees aren't exactly the same as in a big data center like the one in New Jersey. So that difference should be considered, I would say.
Yeah, it's always going to be a higher margin. You're building your own stuff versus just like in someone else's data warehouse.
I'm curious to see if they talk about that Alabama land acquisition.
Yeah,
if they talk about that. I'm curious to see if they bring that up, or at least if an analyst asks a question.
They should.
Yeah, they should, but we'll see.
Do you have the link for the webcast, Neil? Because last time we had a.
Yeah. No, this time it's a little bit more modern. You can find it on the
it was
on
like
the website directly.
Website.
So it's not on Zoom.
Yeah, no. There is now a button join the webcast like every other normal investor relations website.
Maybe they might have it next quarter. We'll see. It doesn't really seem like the kind of crew that would be like, "Hey, we need to be all about the retail right now." You know, it's
Roman just posted something.
Yeah, I saw that too. We sold all we had. We'll build much more. Is what he said. This is Q3.
As simple as that.
Yeah. Oh, that I saw we're urgently looking for a technical writer. That was a previous post. Nice. I'm not gonna lie. Like this image, he looks like Adam Sandler. Like it's uncanny how much he looks like Adam Sandler in this picture.
Yeah, his profile.
I don't know if you'll ever take that joke. Like I don't. You would know, Manuel. You
interviewed him.
What? Yeah. What? Sorry, I was
telling Roman that he kind of looks like Adam Sandler in his picture.
Yeah.
Like
he really looks like Adam Sandler. There's some photos. I mean, when you're like, for instance, when I was interviewing him, I wasn't, because it's different when it's live, because I mean, he's always moving his head. But there are some pictures where he really looks like Adam.
I mean, stock doesn't move much, even if there is a delay. I mean, we'll know when they announce a delay or not during the call if it's going to move or not. But I mean, if we go back under 100, I'm not going to complain much.
Yeah, I mean, NASDAQ is also down 0.5%. So I would say for the NASDAQ being down that much after this quarter, if it really like was such a bad quarter, it would have been down way more. Like we would have saw that low 100 stick, but just hovering around here. But yeah, we'll definitely get more clarity once a call starts and probably once a market opens.
Yeah, I mean, CoreWeave is down 10%.
Anything on the subsidiaries you guys could see? I'm trying to read through those to see if there's anything that calls out.
Let's see. We've got some AV right. I think it's like A4 AV right is the Uber. It's the Uber thing.
215K deliveries year to date. Robotaxi launch, 2 times revenue growth in 10. We didn't get a valuation update for ClickHouse. I'd assume that's probably going to happen in the next few months.
Yeah, I think they called out the latest round was like 5.8 billion or something in May, which we all knew about.
6.5, I think, no?
It says 6.35 here, but that valuation has to be somewhere around 8 now, at least.
Oh, yeah.
And Toloka just says the usual, backed by Jeff Bezos. Or Bezos Expeditions. They used to break these other ones down in like previous quarters, like not the last one, but like a couple quarters ago, and then they just stopped doing it.
Yeah, because it's immaterial, let's be honest.
Yeah, it's not super important. People are trying to follow that, but I think they do mention. I'm still checking stuff out here, but they did mention like they did comment on the profitability of the other businesses, which ultimately like it's going to be funding the core business no matter what. Like that's what the other businesses are there for. It's not trying to be like a separate running ship, but they want to grow into a multi-billion-dollar run rate or anything like that.
Yeah, analyzed ARR by the end of September was approximately 551 million.
ARR in September?
Yeah, they said the analyzed ARR by end of September was approximately
551 million. So it's impossible to reach the target.
Yeah,
I mean,
that's sort of what I'm reading too.
Not impossible, but it would require the New Jersey's location to be deployed, which doesn't seem to be the case. I mean, the utilization rate of that site will be like 100% right away because of the Microsoft deal, or I mean, even if it's not 100%, like at least 90, I would say. So if they get, I think they will probably say during the call, like, if we get the New Jersey location on time this year, we might reach our guidance, our previous guidance. If we don't, probably we will miss it, but like reach it by the first quarter of 2026 or something like that. Especially if they said Meta's deal will the capacity will be deployed in the next 3 months. I mean, that means it will be deployed by Q1 of 2026. So, I mean, probably the first quarter of 2026 will see a huge ramp up in ARR.
Yeah. I mean, it would be nice to hear those stuff, but I mean, with all these companies, like it is literally like you just got to look at the run rate for 2026. Like I was surprised with Iran. I'm surprised with this one. I don't know about CoreWeave. Let's just hope we don't hear any PowerShell delivery delays, because that was attributed to the delay with CoreWeave, the power delivery, and then Jose was saying that that it could be because of people are speculating it's because of Core Scientific. So if there are delays for this one, they're going to want to know the reason why. Otherwise, Michael Burry is going to be pounding the drum out there.
I don't know how you can short NVIDIA with these data center plays.
I mean, if we look at the end to September ARR, approximately 551 million. So it's 46 million for the last quarter. You multiply that by 3 and you get like for the quarter itself. So it's 138, but our quarter is a bit over that. So I assume it's going to accelerate from here. Might not reach the 1.1 billion. Maybe 900 million is maybe possible ARR, because essentially you only need to end the last month pretty high, and then they multiply that by 12 to reach a number quite close to their own guidance. It's not that far-fetched, but the fact that we're not getting any number in the letter might be because they'll miss it by a bit.
One point is that the ARR for them is like the revenue of last month
multiplied
by 12.
Yeah,
so
correct.
So if they get the New Jersey location just at the end of December, they will only get a few days of revenue. So even if you multiply by 12, it's probably not enough to go there. But I mean, it's not entirely relevant. But it's the French guys always.
Yeah, because
people talk about the Russian guys, but I mean, the Russians are not the problem here.
I remember when he commented like, oh, in the next 30 days we're going to announce something mind-blowing. I don't know about you, but I think it's been like 60 days or something since that comment.
And we still have nothing. He said 45 days, but it's been like 70 or something like that. Poor Charles.
But yeah, I mean, probably 1.11 billion ARR is a bit too much, because it will have to accelerate quite quickly. As long as we get quite close to it, it's fine, especially since we got that new ARR for 2026.
Which is, I feel like, a classic thing companies do. We're not going to hit this year's guidance, but we're going to increase next year, so don't worry about it.
I think what matters is why it's delayed versus being delayed, period. So, and the not only the reason why it's delayed, but like what caused the delay in the first place. Like it would really suck to hear if it was at the fault of like building capacity or whatever it is. I mean, it is what it is, but then that might put people being skeptical. Like, can you really reach 2.5 gigawatts capacity by the end of 2026 and all this stuff? Like, I think that would probably be something that would shake the stock a bit if it was something as far as like delayed build out, because now I mean like delayed revenue and so on. I know to us like it doesn't really matter, but I think for the audience they might
know sure
why the stock might be down, if it is down or not, just to call that ahead of time.
But this guidance is real. I mean, I wasn't expecting like. Yesterday I was wondering like they will probably issue a 2026 guidance, especially with the Microsoft contract, and because I was already like fearing that the guidance for this year was not going to be achieved because of the New Jersey location. So in my mind, I was like, oh, so they might say like, we're guiding for $5 billion by the end of 2026. I literally made up this number on my mind, and now they guided for between $7 and $9 billion. So it's just, I mean,
you're too bearish.
Yeah. And as I wrote in a post like a few minutes ago, when I started researching Nebius, like at the beginning of the year in January, and you, Neil, probably also remember this.
Yeah.
They were guiding for 240 megawatts in the midterm.
Yeah.
In the midterm, which was like 2027, 2028. So now they're guiding to over 2.5 gigawatts in 2026. It's just like crazy.
It's unimaginable. Like you see how many gigawatts that each one of these neo clouds and infrastructure companies or Bitcoin miners, whatever it is, like it's just guiding for, right? Like you had it with Cypher, where they just out of nowhere came up with like a 1 gigawatt plus facility in Texas, and then you had Iron looking for 2.9 gigawatts by 2027 or more. And I have Nebius 2.5. It's just, what do you guys not see that there is a demand problem? A supply problem out there? It's so plain and obvious at this point. So, but you and I were there, Manuel. I mean, in the 20s, did not think this was $100 stock in just a few months.
I mean, I can't say I didn't think of that because I comment with my friends. I mean, I never said it on X because I always feel like the responsibility to be down to earth and all that. So when it was at $20, I was always setting my target to $60+ by the end of this year. So I mean, it was clearly achieved.
Yeah.
But to my friends, like my personal friends, I was always saying, we're going to 100 this year. We're going to 100 this year.
This is 100 times opportunity right here.
No, not like Linares, but I was literally saying that. I even have conversations like recorded, not recorded, but registered. But
you recorded it. You recorded. You just slipped. No,
but I wasn't expecting like to be this not this quick, but with such execution. Like because when I imagined that, I was like, okay, so maybe when we reach $100 per share, it will probably be already a bit stretched in terms of multiples or something like that, because I was basing myself on the previous targets. So I mean, if they didn't raise like every quarter estimates by not only these year estimates, but mostly the capacity expansion through 2026, maybe the stock would be already fair value or even a bit overvalued if it was based on the previous estimates, like from the beginning of this year. But now I just can't look at it and say that the valuation doesn't make sense. I mean, I can, but it's on the inverse side. I think it justifies and especially when looking at CoreWeave, because CoreWeave is even after this crash is at like what, $50 billion?
Yeah.
$50 billion.
I keep turning it on and off, and it's just blasting some music.
Blasting music.
Yeah, dude, the volume in the call is so loud. Yeah, it's blasting some sort of music.
Someone asked, Manuel, do you offer our close friends going off the charge Substack?
I should sometimes.
Yeah, it's planning to leave the company, sources to Financial Times. Oh, jeez.
Yeah, he's going to launch his own startup. It's called regulationai.eu.
Did it say though why he's planning on leaving, or it just says that he's planning on leaving?
Yeah, to launch the startup.
Oh.
The name of it, I don't know.
Yeah, I know. I was gonna say, like, hold on. I thought that was a joke. I thought that was a joke, man. I thought that was a joke.
Also, for anyone curious, the dilution is 10% of total shares. Just to put a percentage on it.
Yeah.
But I'll take it to grow 700%.
Yeah, I mean, it's
shareholders shouldn't care, in my opinion, if we're growing like this.
Well, I mean, now, like, if the stock is down, it's be like, well, that's the reason why it's down. It's like, well, if the stock was up, you wouldn't have said that, right?
Vice President of Investor Relations. Joining me today are Arkady Volozh, founder and CEO of
Can you hear it?
And our broader management team.
Yeah.
Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our report on Form 20-F filed with the SEC. We undertake no obligation to update any forward-looking statements. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release, shareholder letter, and accompanying investor presentation are available on our website at nebius.com/investorhub. And now I'd like to turn the call over to Arkady.
Thanks, Neil, and thank you everyone for joining the call today. I'd like to share my thoughts about the demand environment, about our capacity plans, and what we're doing in our product. First, about the demand. Q3 demand was very strong. We sold out all of our available capacity. We continue to see a consistent trend. Every time we bring capacity online, we sell it, all of it. With the new generation of NVIDIA Blackwells coming online, more customers are interested in purchasing capacity in advance and securing it for a longer period of time. Today, we're very pleased to announce that we signed another major deal, this time with Meta, for approximately $3 billion over the next 5 years. In fact, demand for this capacity was overwhelming, and the size of the contract was limited to the amount of capacity that we had available, which means that if we had more, we could have sold more. This deal comes on top of the Microsoft deal we announced early in September, with a contract value between $17.4 and $19.4 billion. As we said before, we expect to sign more of these large long-term deals, and we're delivering that promise. As busy as we are with these mega deals, our main focus is still to build our own core AI cloud business. We made great progress here with AI-native startups like Cursor, Black Forest Labs, and others. The economics and the cash flow of mega deals are attractive in their own right, but they also enable us to build our core AI cloud business faster. This is our real future opportunity. Now on the capacity. In order to meet the growing demand, we have accelerated our plans to secure more capacity, and this is actually our main focus for now. Capacity today is the main bottleneck to revenue growth. And we are now working to remove this bottleneck. As we look to 2026, we expect our contracted power to grow to 2.5 gigawatt contracted. This is up from the 1 gigawatt which we discussed in our previous earnings call in August. Furthermore, we plan to have power connected to our data centers, which means fully built, of approximately 800 megawatt to 1 gigawatt by the end of 2026, by the end of next year. While we made significant investments in our capacity footprint, we are also investing in our main product, our AI cloud. To expand our addressable market opportunity to larger enterprise customers, we released our new enterprise-ready cloud platform version 3.0 called Ether, and our new inference platform called Nebius Token Factory. We believe Ether gives organizations the trust, control, and simplicity they need to run their most critical AI workloads. Nebius Token Factory is a production-scale inference platform that enables organizations to run open-source models with reliability, visibility, and control. And we have a large pipeline of new software and services that we are continuing to build, which will differentiate us from other cloud companies. Based on the strength in demand that we see and our accelerated capacity growth plan, we believe we can achieve annualized run rate revenue, IRR, of $7 to $9 billion by the end of 2026. In summary, Nebius is positioned to win in this large and rapidly expanding AI cloud market. We're just beginning to realize the powerful potential of the AI revolution that is underway, and we are quickly becoming one of the primary cloud and infrastructure providers to support it. And with this, I would like to hand the call over to our CFO, Dado Alonso. Dado, please.
Thank you, Arkady. While the details of our Q3 financial performance can be found in our shareholder letter, I'd like to provide some additional color to the quarter, discuss our financing options, and conclude with 2025 guidance. Q3 group revenue was $146 million, up nearly 355% year over year and 39% quarter over quarter. Annualized run rate revenue for the core business at the end of September was $551 million. The core infrastructure business, which accounted for nearly 90% of total revenue, grew 400% year over year and 40% sequentially. Once again, we sold out our capacity, and our revenue growth was limited only by the capacity that we were able to bring online. I'm also pleased to say that adjusted EBITDA margin for the core infrastructure business expanded quarter over quarter to nearly 19%. On financing, in order to support our aggressive growth plans in 2026 and to maintain this pace of growth in 2027, we will be utilizing at least three sources: corporate debt, asset-backed financing, and equity. We are in the process of raising asset-backed debt, which we'll be able to secure with attractive terms supported by creditworthiness of our largest customers. Tomorrow, November 12th, we will be putting in place an at-the-market equity program for up to 25 million Class A shares and plan to file a prospectus supplement. We will evaluate the program regularly based on our capital needs. The program enables us to access equity funding on an efficient ongoing basis. However, we will remain dilution sensitive as we prepare to finance future growth opportunities. Now, I would like to turn to 2025 guidance. As we approach the end of the year, we are tightening our full-year group revenue guidance to a range of $500 to $550 million, and we are currently pacing to the midpoint of that range. This compared to the $450 to $630 million in our previous guide. The reason we are in the middle and not at the top of that range simply relates to the exact timing of when capacity comes online. Our current momentum and long-term trajectory remain extremely strong. Our annual run rate revenue, which is a good reflection of our future growth opportunity, continues to expand, demonstrating the resilience and scalability of our business model. As such, we remain well on track to hit our ARR guidance of $900 million to $1.1 billion by the end of 2025, while also paving the way for substantial annualized run rate revenue growth in 2026 and beyond. In terms of the mega deals, we will begin serving Microsoft and Meta late in the quarter, and almost all of the revenue from these deals will start to be realized and ramp up during the course of 2026. We plan to give full-year revenue guidance for 2026 next quarter. Turning to adjusted EBITDA, as we have previously indicated, we expect to be slightly positive at the group level by year-end, while remaining negative for the full year. Regarding CapEx, we are raising our 2025 guidance from approximately $2 billion to circa $5 billion. This acceleration reflects our strong conviction in the demand outlook and our decision to secure critical infrastructure, including hardware, power, land, and key sites. These investments are strategic enablers of future growth and will position us exceptionally well to capture the opportunities ahead. In summary, we have a large and rapidly growing opportunity in front of us, and we are executing with focus and discipline to capture it, while delivering sustainable growth and setting the stage for strong long-term profitability. Now, let me turn the call over to Neil for Q&A.
Great. Thank you, Dado. We'll give it a moment to collect questions from the online platform, and then we'll begin the Q&A.
Surprised we're still hitting
All
the
right,
ARR guide.
let's start with the first question coming from Alex Platt of D.A. Davidson. Can you tell us more about that deal? Why did they choose you, and how should we model the deal? Arkady?
Well, again, as we're happy to announce today, this new deal with Meta, approximately $3 billion. As I said, the size of the deal was limited only by the capacity that we had available. And if we had more capacity, we could have signed a bigger deal, probably. After we announced Microsoft in September, we said that we will have more deals of this kind, more large deals. And actually, we're delivering on that promise. And we're optimistic as these deals will arise more and more. However, these deals are important, these mega deals. It is important to stress that we will remain focused on developing of our own AI cloud, which currently serves not only these big deals, but AI startups and enterprises. And ultimately, we believe that these large contracts provide us with great sourcing of financing for us to continue building our core AI cloud business.
Great. Thank you, Arkady. We'll take the next question from Alex Duval, our analyst from Goldman Sachs. So we provided the updated 2026 ARR outlook of $79 billion. What exactly is in the $79 billion ARR target? And is this based on pre-existing core business plus Microsoft and Meta? Is there anything else in terms of signing up for large deals? Mark, maybe you can take this one.
Thank you, Alex, for your question. And let me walk you through the building blocks of how we get to the $7 to $9 billion in ARR. First of all, as we already shared, we had a bottleneck in capacity, and we worked extremely hard over the last several months to unblock this bottleneck. As we shared, we plan to have 800 megawatts to 1 gigawatt of connected power by the end of 2026 and 2.5 gigawatts of contracted power. Second, we see the demand out there from AI startups to enterprises to the large strategics. And we see that client demand that we were unable to sell this past year due to a lack of capacity. And we strongly believe that the capacity we are putting in place in 2026 will help us to meet more demand. At the end of the day, we will allocate between the categories of customers based on the individual economics of the deals they represent. Thirdly, this new capacity that we are putting in place, together with our current capacity that has already been sold, and the long-term contracts that we signed with Microsoft and Meta, gives us the confidence that we can achieve the $7 billion to $9 billion of ARR, of which more than half is already booked.
Great. Thank you, Mark. See, we'll take another question from Alex at Goldman. Can you walk us through the timeline of your infrastructure build-out for Q4 25 and 26, and what gives you confidence that you can reach your 2.5 gigawatts goal of contracted capacity? Andre?
Hello, yeah. Thanks, Alex. So we are ramping up our capacity as fast as we can to accelerate our growth for the next year and beyond. We are happy to launch now already Israel and UK, and all the capacity in those regions were pre-sold before the launch. And we are growing with the numbers of the regions where we are present, and we also bringing new capacity online in the current sites. We're also coming online in New Jersey. We are launching new phases of Finland in Q4, which are also pre-sold, by the way. In 2026, we will continue scaling the existing data centers, including UK, Israel, New Jersey, and we have new data centers already in development, both in US and Europe, and they start to come online in the first half of 2026. We also in the process of securing several new large sites, which we believe will add hundreds of megawatts, and some of those will go online by the end of 2026. So overall, at the moment, we are looking at more than or around 2.5 gigawatts of contracted power by the end of 2026. And as we said, demand is growing massively, and we are very focused on rapidly building the capacity and the future pipeline to meet the demand in 26 and beyond.
Great. Thank you, Andre. All right, we'll take a question from some of the folks who've been submitting questions. We're getting a lot of questions on Microsoft and Meta revenue. How should we be thinking about revenue contribution from Microsoft and Meta deals for this year and going forward? Dado?
Well, the Microsoft contract will not have a material effect on our revenue and ARR in 2025, as the first tranche was just delivered. All of our remaining tranches will be delivered in 2026, with more than half of them during the second half. So we actually expect revenue to ramp up over the course of the year. Starting in 2027, we will begin to recognize the full annual revenue run rate of the Microsoft deal. With regards to Meta, we will be concluding the deployments within the next 3 months, so we expect to mostly be at a full revenue run rate in 2026.
Great. Thank you, Dado. Maybe another question from our online audience. What does the overall demand environment look like in Q4 and into the next year? Mark, do you want to take this?
Certainly. I joined the company about 5 months ago, and I've had an extraordinary experience in these past 5 months. It's extraordinary from the standpoint that I've never seen the kind of demand profile that we're experiencing. It is literally accelerating for Nebius, and I believe as well for the broader market. As an example, in the recent quarter and quarters before, we saw pipeline generation. This is opportunities by customers that want to buy from us expand. As a matter of fact, in the past quarter, Q3, we saw pipe gen expand 70% quarter on quarter, and we generated $4 billion in pipeline in that quarter. but we were only able to convert a portion of that given to the constraints of our capacity. As a matter of fact, I've learned a new skill, one I don't think many go-to-market professionals have ever had to experience, and that's learning to say no to customers as we routinely sell out and have to actually let them down lightly and try to convince them to purchase in the future. As I look out to 26, and I think through the demand profile, the kind of pipeline that we're generating right now is giving us high confidence to continue to expand our results and drive towards the ARR growth that Arkady mentioned earlier on the call.
Great. Thanks, Mark. We have a question now from one of our analysts, Nehal Chokshi from Northland. Incremental in September quarter was around 12 million, down from 180 million in the prior quarter and 159 million in the March quarter. Why is incremental ARR down? Nehal, it's a great question. As we've stated, a lot of our revenue and our ARR is really dependent on us being able to bring on capacity, and because capacity really has been the bottleneck, that's why we've seen a little bit of that trend. However, as we're bringing on a lot of capacity in Q4, you should see that incremental ARR in Q4 will be significantly higher. All right, let's go to another question from online in terms of the CapEx. You have just announced your plan to achieve connected capacity of 800 megawatts to 1 gigawatt by the end of 26. How are you thinking about CapEx, and what is your philosophy on CapEx spending? I think Arkady, can you take this?
Probably should take it. Again and again, as we see, at least this year, our revenue growth was limited by our capacity, and everything we built was ultimately sold. So in theory, we should try to build as much as we can. In practice, though, we're limited by certain physical world limitations. Physical world cannot grow 5 or 10 times a year. We have limitations in supply chain and obtaining permits, amount of capital that we can deploy. So when we plan for data center CapEx, there are actually 3 stages there. The first stage is securing the land and power. The second stage is building the data centers themselves, including the shell, electrical and cooling equipment, batteries, and so on. Physical installation, which we call connected power. And the third part is finally deploying the GPUs themselves. And if we look at it from the CapEx point of view, roughly speaking, it breaks into 3 spending blocks. So first stage, securing land and power. It's pretty cheap. It's around, again, it depends on the scale, but it's around 1% of total CapEx for securing those blocks and electricity. The second stage, building the data centers, building connected power, is something around, 18-20%. And the remaining 80%, the main part, is for deploying the actual GPUs. This is the main part of CapEx. So if we want to build as much as our capital will allow us, what should we do? First, we should secure as much capacity as we can, because the cost, actually, it's not so, it's immaterial at this scale. Second, we should build as much as our capital allows. And third, we will fill GPUs in line with contracted or clearly visible demand. We will need this massive 80% spend will come only when we see real demand. That's why we say that in 2026, we will be securing 2.5 gigawatt total contracted capacity. And we are planning to physically build 800 to 1 gigawatt of connected data centers. This will be done by the end of next year.
Great. Thank you, Arkady. Let's see. Another question from Alex Duval from Goldman Sachs. You have announced your target is 2.5 gigawatts of contracted power, whereas before it was 1 gigawatt. Is it fair to assume that if you get 2.5 gigawatts This will equate to over 20 billion of revenue. By when do you envisage you could do this, and how? Maybe we'll give this to Andre.
Thank you, Neil. I guess it's fair to assume, but as Arkady just mentioned, we are securing the access to the power and the ability to build, but we will invest CapEx actually in building out and deploying the GPU in those, keeping in mind the constraints that we have with the capital and according to the demand in the future periods. It's just important that we are able to accelerate when it will be needed. So we don't like being blocked by the capacity constraints all the time.
Great. All right. Take another question from online. Is it in a situation when you are sold out, is that the same issue, or is that really an issue with your future growth and differentiation of servicing a broader range of customers? Mark, can you take this one?
Certainly. Thank you, Neil. It's a great question. I mean, in theory, the situation of being sold out is a nice problem to have. But the person asking the question is right. For our business model, it's really important for us to be able to not only service large tech companies, but also be able to support our AI cloud and a very diverse set of customers. As a matter of fact, servicing startups and software vendors and enterprises is not only about delivering on their capacity needs today. We want to build partnerships with these customers and help them to meet their capacity requirements in the future, especially with enterprise. We are working very closely with Andre, and as Andre mentioned earlier, as we look forward and think about deploying capacity, it's going to be based on the demand that we're seeing out there. So utilizing the pipeline that we're building and the demand that we're experiencing to work with Andre to identify the capacity that we should deploy. It's a very dynamic model that we're trying to put in place.
Great. Thank you, Mark. Appreciate that. We have a question from Nehal Chokshi from Northland, who's asking, so you've done equity deals. We've also done, equity linked deals as well, Dado. How will we focus on debt and asset-backed financing for large deals?
Thank you, Nihal. Well, as you know, this is a capital-intensive business, and as we've said previously, funding our growth will require raising a significant amount of capital. In this context, we are actively evaluating a range of financing options today, including asset-backed financing, corporate-level debt, and equity financing. And we are working on all fronts in order to maintain a disciplined capital structure to maximize our shareholder value. With regards to asset-backed financing, we believe that we will be able to secure such a facility with attractive terms supported by the creditworthiness of our largest customers. I would like to reiterate that as we are growing our business, our focus and ultimate goal is to maximize our shareholder value.
Great. Thanks, Dado. And maybe just sticking on the theme of financing from the online portal, why are you planning to pursue an ATM? You just completed a secondary, and this will result in additional dilution to shareholders. Any thoughts, Dado?
Let me share some perspective. We will be putting in place an at-the-market equity program for up to 25 million Class A shares, and we plan to file the prospectus supplement tomorrow. We want to make sure that we have more tools at our disposal to access capital markets when needed. This is a long-lasting program, which will be used along with other capital raise options, including corporate debt, asset-backed financing, and others, as I mentioned in my opening remarks and just before this question. So the program enables us to access equity funding on an efficient, ongoing basis. However, we will remain dilution sensitive as we seek to finance future growth opportunities.
Great. Thanks, Dara. Let's see, another question from online. How are the early operations of your new UK facility progressing? Tom?
Yeah, no, absolutely. So the short answer is progressing very well. You may have seen just actually last week, Arkady and a few of us were there. We had our official launch as we brought the data, presented the data center to the UK market. This is actually capacity that will be coming online really actually in the next week or so. So very in the coming days. You might remember actually that in June was when we first announced our intention to launch in the UK, and actually even in the time since June and now we've already come close to doubling the capacity that we're bringing on stream. You know, and that's just really a function of extremely strong demand that we're seeing in the UK. And actually, as is often the case with new capacity that we bring on, even before going live, we're pretty much sold out. So I think if not already fully sold out with that capacity. So that that's a trend that just continues. I would just say overall a few words about the UK. Actually, I mean we're very bullish actually about the opportunity in the UK. It's a vibrant AI market. It's probably one of the most dynamic that we see outside of US and China. The government's making a big push to support the growth of the industry and having a reasonable degree of success in this field. So we see a lot of AI startups. VC environment is strong. You also see some of the large tech companies establishing regional R&D and presence there. So really, there's a lot happening in the UK, and we think a lot still to come for Nebius in the UK. And we're very happy to be there. And actually, although this specific facility that we have, I think with the capacity, once by January we'll have reached the peak capacity there, we see a lot of other opportunities to expand capacity in the UK overall.
Great. Let's see. In terms of, we'll take another question on capacity. So, you mentioned this quarter that you're fully sold out of available capacity. What are your constraints to growing in the near term and medium term to capture more of that demand? And could you also address some of the recent comments on the market around power equipment constraints?
Yeah, I'll take it. Yeah, thanks, Neil. As we discussed in most of the previous question, capacity remains our main bottleneck. Everything we deploy, we sell. And we see the demand that continues to significantly outstrip our supply each time we add new clusters. So in near term, the key challenges to increasing capacity are securing power and supply chain. And we're addressing this. We have managed these situations in the past, have quite a bit of expertise of building on the data centers and operating those. So overall, we are managing. Generally speaking, we are doing quite well actually with the pipeline. And when we spoke last quarter, I believe that we announced that we have secured the roadmap of the 1 gigawatt of the power. Now we are talking about the number 2.5 gigawatts, and we are still putting a lot of focus on growing this number and making this number reliable and effective and actually bigger.
Great. Thank you, Andrei. Online, we're getting just a few questions about any updates on the New Jersey facility. Andrei, do you want to take that?
Yeah, New Jersey facility goes as planned, and the first tranche already was handed over to Microsoft, and we are continuing the further expansion.
Great. All right. Looks like a question from online, maybe more of a market question. Are you concerned that we are in an AI bubble? Arkady?
Everybody asks this question these days. Well, what we see today, the demand is here, right? And we understand that we are in the center of a once-in-a-generation AI revolution. No doubt that much more compute will be needed and much more will be built. This situation of unbalanced demand supply is temporary. Of course, eventually demand supply will level up. And what we're doing, in addition just to growing this raw capacity, we are building our AI cloud, which will support real businesses, real industries, real enterprise market, where AI will be creating value. And we're big believers that the AI industry in general, in our sector specifically, it's going to be okay. Ultimately, we just need to be sure that we're diversified in terms of customers and workloads, and this is actually what our software is basically doing. B, that we invest conservatively and that we finance our growth responsibly, and we are very much focused on this. And also, while we're growing rapidly, 5 times more a year, we still remain largely focused on maintaining healthy margins and a sustainable business model as a whole. In old days, I would say, healthy unit economics. So we are focused on that, and whatever comes will come. We hope that we will be okay.
Great. Thank you, Arkady. Next question is from Alex Platt from D.A. Davidson. How should we think about the lead time between when power is connected to and when it is hooked up to GPUs and generating revenue? Andre?
Yeah, thanks, Neil. So on the technical side, it also depends if it's a new site or if it's expansion of a current site. But generally speaking, from the connected power and start of the GPU deployment until it can go in the platform and generate revenues anywhere from 6 to 12 weeks. If it's already existing site, that can be even quicker. But generally, we also have a flexibility. That's why we're building infrastructure. We have a flexibility when we deploy, and when we deploy and how much we deploy.
Great. Thanks, Andre. All right. Question from online. Can you update us on your progress with your primary customer segments? Mark, can you help us with this?
Certainly. We continue to see extremely strong demand from our customers in our core AI business, and we're continuing to expand business overall with our existing customers. As a matter of fact, we added a number of new customers in Q3, most notably some very disruptive startups like Cursor AI, Black Forest Labs, and World Labs. I'm sure everybody's heard of Cursor. We're very, very proud to be their partner. For those that haven't, they're an extraordinarily popular AI-powered code editor that is helping millions of developers to write and debug and optimize their code faster, and they're making great strides into the enterprise. Black Forest Labs is a interesting customer that is developing cutting-edge generative AI models, specifically for image and video generation. Their popular Flux One model helps turn text and images into high-quality, media-ready visuals. And World Labs is building something they call a large world model, which is able to simulate 3D worlds, and it gives developers and AI engineers the necessary spatial awareness to build applications for things like media and gaming and architectural design, and as well for physical AI and robotics. We've also, as I mentioned, seen expansion with existing customers. As a matter of fact, as an example, we've seen expansion with our software vendor customers like Shopify. And then also we've made great strides with our efforts around driving vertical market success, adding significant customers in our healthcare life sciences part of the business. And we're also making significant advancements in physical AI and media and entertainment customer segments.
Great. Thank you, Mark. Maybe a question looks like this is a question for Dado. A few people are asking, any puts and takes that you can provide on your revised 2025 year-end revenue guidance?
Well, our business is actually scaling rapidly. There can always be fluctuations in the exact time of deployments in such a fast-growing company like ours. And our focus remains on building a very large company, obviously much larger than today and significantly bigger than our plans for 2026. This was and continues to be our main focus. In any event, our annualized run rate revenue, which is a better reflection of our future growth opportunity, continues to expand, demonstrating the resilience and scalability of our business model. As such, we remain well on track to hit our ARR guidance range of $900 million to $1.1 billion at the end of 2025, while also paving the way from substantial revenue growth in 2026 and beyond.
Great. Thank you, Dado. See, question from the online community. How is your enterprise initiative ramping up? We seem to make some good improvements there over the past couple of quarters. Mark, do you want to help take this?
Certainly. Yeah, we are making strides with regard to becoming enterprise ready. As you saw with the launch of Nebius 3.0, what we call Aether, we've delivered a number of AI cloud improvements to support enterprise requirements. As an example, in the Aether release, we are delivering really important compliance and security certifications. And we did this, as a matter of fact, in a matter of months, when it would normally take other organizations a lot longer to deliver these types of capabilities. As a matter of fact, as well, we delivered some important functionality that enables enterprise administrators to proactively manage their implementation. So tooling and controls like identity and access management and dashboards for evaluating the performance and security of their implementation. I think, as we all know, the sort of the critical foundation for enterprise readiness is to have these kinds of compliance and security certifications in place, and the enterprise functionality that enterprise is looking for. And the third is to have an enterprise-ready sales team. On that front, we are adding a number of key leaders to our organization, and we are expanding the overall sales organization for coverage in enterprise, software vendors, and key verticals. It'll take some time for the sales team to ramp, but we are building the foundation between the functionality that I mentioned and the overall team coverage that I think will set us up for a strong 2026 with enterprises.
Great. Thank you, Mark. Keeping with our online investor base, you recently launched Token Factory. What is the opportunity around this, and will this expand your market or open up new segments? Maybe we'll ask Roman to take this one.
Yeah, thank you, Neil. Happy to talk about our new launch. So I will start a little bit from demand evolution. we fairly see now the next wave of AI demand growth, and it's mostly driven by the companies, by the people who apply AI to real-world applications across all industries in B2C and B2B. It's not necessarily foundational model builders like it was, let's call in the first wave. And we as Nebius realized that we needed our inference as a service offering to make it serve a broader set of customers, including enterprises. So Token Factory gives vertical AI product builders, ISVs, and enterprises a platform to build, we call it flywheel of applying LLMs in vertical AI use cases at scale. We help them to transform open source models into optimized production-ready systems with guaranteed performance and transparent cost per token. We obviously leverage the underlying infrastructure to bring the most efficient, scalable solution to our customers when they can be sure that they get the best total cost of ownership and can confidently grow with us. So as a result, organizations can deploy and scale models such as OpenAI OSS, Qwen, DeepSeek, Llama, Nematron, and many others on dedicated endpoints with guaranteed performance tuned for the super latency and 99.9 uptime. So in total, I must say we are excited about the opportunity of inference workloads. We believe that all companies will invest in inference to productize AI, and for us it will require significantly more compute and will support this wave of growth as well as we do for foundational model builders.
Great. Thank you, Roman. Jumping back to online, looks like we have some additional questions here. What demand are you seeing for new Blackwell generation, and how is this demand from the previous Hopper generation? Mark, do you want to take this one?
Neil. Yes, certainly. Thank you, Neil. Demand remains very strong across all types of GPUs. And as we said, we sold out our capacity in Q3, and that's across all types. And we're nearly sold out with respect to Q4. Talking about the Hoppers, we continue to see extremely positive demand for these chips. An interesting set of dynamics that we're experiencing is that as customers come to their renewal for Hoppers, or if they're looking to upgrade to, say, Blackwells, in both cases, we're typically selling them immediately, and often at better pricing than they were previously priced, as we're actually in tandem rolling out the Blackwell. So very strong demand profile for existing Hoppers. We're also seeing very strong demand for Blackwells, and we're benefiting from the fact that we're one of the first companies to deliver them in the market. In our Israel data center, we launched with B200s, and in our UK data center, we launched with B300s. And we've essentially pre-sold much of that capacity before these facilities even opened. We're very excited as well that we're launching GB300s. We're the first to do so in Europe, which will be coming online in our Finnish data center later this quarter in December. Thinking about in-production capacity, we're right now, as I mentioned, selling the remnants of Q4, but we're also now pre-selling new capacity being delivered in future quarters. So we're seeing a very strong demand across all types of GPUs, And as I mentioned earlier, and as Andre mentioned earlier, we're working in close partnership with Andre's team to make sure that our sales pipeline allows us to drive our model in order to be able to support GPU requirements in subsequent quarters.
Terrific. Thank you, Mark. Another question from Alex Platt from D.A. Davidson. He's asking about our strategy regarding larger deals. Do we have medium-term capacity targeted for these deals and customers? Arkady?
Yes. We are very opportunistic here. The demand is there, not only for our everyday deals, but for large mega deals as well. And we'll enter into the deals which provide us with the best margins. We're very much focused on margins and profitability, not only on growth itself. And all our decisions actually derive from there.
Great. Thank you, Arkady. Next question from Andrew Beal from Arete. Can you provide more details regarding some of the greenfield sites? Do you have LOIs for further new US and EU DC locations, or are you further down the road with these? Andre?
Yeah, thanks, Neil. Generally, we are making a great progress to bring our capacity. We have a robust pipeline, both in Europe and US. We mentioned that we are on the way of securing 2.5 gigawatts of, roadmap for the power in the next year. We are in LOI stage and also further down the road as well. But we are not in a position to say more at this stage.
Great. All right. Question from online. Can you provide an update on your facility in Israel? Tom?
Yeah, sure. So as you can see, we're growing rapidly. So just last week, we were in the UK launching, and just a couple of weeks before that, we were in Israel. And actually, the data center facility that we have there is already fully live. And as I think we've made various references to, Mark's mentioned it previously, again, that was capacity that was effectively even pre-sold. And we definitely have opportunities to expand further in terms of capacity. We think Israel is a great market. We see a lot of demand. There's a lot happening in tech and in AI. And actually, one of the things that's interesting about the market, I mean, our decision to go in there was purely based on our own commercial considerations. We think there's a lot of growth for that. But actually, the government's also doing some interesting things, really to stimulate further demand. And so they're actually effectively putting money to subsidize sort of AI startups and institutions and helping them to access the compute as a way of having the growth move faster. So we think it's anyway, we're doing great there. We think there's a great opportunity for us. And actually, the model there might even be a model that we think even other countries might look at that are thinking about building up their domestic demand in AI industry. So overall, going great.
Great. Thanks, Tom. All right. From our online platform, let's see. How do you think about partnering with or buying potential companies that already have secured power or land, or consolidating other neoclouds? Arkady?
Well, on companies which secure power and land, again and again, it's all about margins. We're pretty much focused on the margins when we enter into a new contract, when we're raising capital, when we're developing new plots for data centers, when we design those data centers, when we build our own racks, software. So we vertically integrate, and we're looking on efficiency on each stage. We have looked into potential acquisitions of power land market, but so far our approach proved to bring, I would say, much higher margins so far. So we're still moving further and further into building our own facilities, and we're actually decreasing the share of our own over co-located rented facilities. more and more will be our own facilities. Obviously, we will continue to consider different opportunities, but as you can see, we were able to secure a significant level of contracted power organically. So we strongly believe that sooner rather than later, the margins for the infrastructure business will play a significant role in the ability to the business to grow and develop. And we basically remain very focused on that.
Great. Thank you, Arkady. All right. Let's another question, kind of market-related question. Maybe this one will go to you, Arkady. Is there any chance that GPUs are oversupplied in the coming year as new suppliers come to the market?
Two things here. First, we strongly believe that the market will still be supply constrained, at least in 2026. Means that data center capacity will be the choking point. Also, as we mentioned earlier, we plan our capital spend in those three stages: land and power, building the shell and facilities, and then the GPUs. And this conservative stage approach keeps us from overspending, actually, and allows us to maintain a healthy financial position. If there are any changes in the market, we'll be in good shape to weather any downturn, we hope.
Great. Thank you, Arkady. Let's see. Couple of our analysts are asking, in terms of, any big challenges regarding the completion of the Vineland facility, or any challenges to meeting any performance obligations of your Microsoft deal.
Thanks, Neil. I think I already spoke about it. So yeah, as of today, it goes as planned, and we already handed over the first tranche to the Microsoft. So yeah, continue on working according to the plan.
Great. Thank you. All right. I think we'll end the call there. Thank you, everyone, for joining, and we will speak to you again next quarter.
Thank you.
Okay.
Sheesh.
So, first thoughts, Sam?
Oops, was on mute. I mean, I didn't hear anything about delays, which is good. I liked and Manuel, and you guys probably caught it too. They're on track for the $900 to $1.1 billion ARR. Went into details about margins. I mean, margins are super important. They're not just going to take any major deal they can take. Their main goal is to build out their own AI cloud. That is definitely going to be the crux of their entire business. And these large hyperscaler deals isn't really what they're trying to go for. It's enough for the capital funding and to build out the infrastructure. But one thing that we've heard from CoreWeave and a few other companies is that, like, once this is all built out, like, if they don't renew these contracts, like, let's say Microsoft doesn't renew the contract, well, then that capacity is built and it's already depreciated. So they could still make money from it. I'm sure Iron can do the same thing too. Another thing, I posted this. Let's see here. I was posting the live updates while we were doing the earnings call. They saw pipeline generation expand 70% quarter over quarter in Q3. This is the Chief Revenue Officer, Mark, that was talking about this. And they brought in $4 billion of pipeline in Q3. So that's going to continue growing. And they're mentioning many times, like, look, they have to connect with the sales team to not oversell, because that will cause delays, right? Like, if you oversell something, then you're going to come down the road later on being like, well, we can't meet this anymore. So they're in constant communication with the sales team, so then that way they don't put themselves in that issue. We'll see, but I mean, overall, it was a bullish call. I think there was a lot of positive news that came on the call. It wasn't just a repetitive of the press releases, and it's good to hear that affirmation that they're really focused on the cloud, their own cloud business, because ultimately that's going to be the highest margin. That's going to be the stuff they can continue reselling and filling whatever demand there is out there if there is additional supply. And really, that's going to be the crux of it. I mean, inference is a service. When it comes to the new services they're offering, like it's really cool stuff. And finally, sorry to keep on going, but finally, they're mentioning a lot of demand in Europe as well. That's something that we don't really see too often with the other neo cloud players out there. Obviously. And then we saw the news this morning that Microsoft's doing $10 billion in Portugal. Google's doing $5.8 billion in Germany. Nebius is the first company the first cloud to offer GB300s in Europe. I mean, I'm not saying that Nebius is going to be the one signing up with these guys, but like there's some clear demand in Europe out there that isn't necessarily being addressed by almost every single company. And I don't think these hyperscalers can build it out at scale as much as Nebius can or CoreWeave can. So we'll continue to see.
All right, Manuel.
I mean, I'm really glad that and pleased to see that everything is going well. I mean, as I said, I was a bit afraid of having some delays, especially with all the drama around Data One and like not clear timelines. But I mean, it was pretty clear that they're not worried about that. And I mean, I hope that they're really not worried and not trying to hide something, but we have no reasons to believe that. And I mean, overall, it was just another stunning quarter. I mean, last time my expectations were a bit like not that high because of the deconsolidation of Toloka. I thought that analysts were overstating estimates and it could have been a bad surprise, but they crushed. Now, I mean, yeah, they missed analyst estimates because the estimates of revenue were stupid because they didn't bring much capacity during the third quarter. So I was already anticipating a miss there, but it doesn't really matter. The pipeline for 2026 is just crazy. I didn't even imagine Nebius reaching this scale in 2027. I think my last valuation model, which was updated like 3 times this year on the upside, I assumed like 850 megawatts by the end of 2026, something like that, and not surely with already like active. And I mean, I will have to update it again because these guys are like at full speed, and still, even being at full speed, it's not like they're compromising on the value proposition of the company and on the goal of building a sustainable business model. And that's something I really value, which is they said multiple times, yes, these deals are great, and I mean the numbers speak for themselves. But Arkady literally said, yes, there's massive demand for AI compute, but the demand supply levels will stabilize, will level up eventually. He said that, and that's exactly why we are building our AI cloud, and we have our software offerings to essentially have demand beyond the raw compute. So, I mean, I don't see any reason or anything that we could say, well, this wasn't that good. Yeah, I mean, the miss is irrelevant, completely irrelevant, because I mean, if analysts had estimated like a bit lower, it would be, I mean, totally irrelevant. I think what really matters in terms of key metrics, everything was better than I was expecting. I mean, even the guidance for this year, because as I said, I was a bit afraid that we could see like a lower range because of the New Jersey location. And I mean, it could still happen that they don't achieve the target. But still, I mean, if, as I said, if it's not in this quarter, it will be for sure in the next one. But I mean, overall, I don't know what to say. I'm very happy as a shareholder.
All right, Nate.
Yeah, I think you guys hit on most of what I want to say, but overall, I mean, great call. I think a couple things to highlight, and kind of like Manuel was saying, is they're basically hand selecting their customers. So I think the CRO said something, a quote like learning how to say no to specific customers, which means the demand is so there they can just handpick the deals they want. That's great. And like Manuel was saying, without sacrificing their margins, right? They're doing it on their own speed, not overbuilding or over supplying. Another thing that I thought obviously was hilarious was the AA bubble, and Arcadia was just like, "Are you serious right now? You're asking this question?" I thought that was hilarious. He just sighed, angrily answered. I also think that it was interesting comment that I think it was Arcadia that mentioned it, that 1% of capex spend is land and power, and 80% is GPU build out or demand or the pieces there. And so that I thought that was really interesting that he said 1% of capex is basically land and power. It makes sense, but I just interested to hear him articulate it. But yeah, I mean the demand is, insane. When I woke up and saw 7 to 9 billion ARR guide, 2.5 gigawatts of contracted power. I mean, crazy. And also they mentioned that I think over half of the ARR is already contracted for next year, which is like we're in
crazy.
November of 2025 and they're already oversold half of it by now. It's nuts. Crazy quarter. Really good. I'm trying to find some negatives, like legit negatives that I can think of, and it's hard to find.
Yeah, I guess the only negative would be the dilution. Yeah,
but it's like it's just offset by growing 700%.
We need to have cash to build data centers. I mean, they're not like it's not
and
like
I'm surprised
they clap
to see,
the fingers and.
Yeah, I'm surprised to see the fact that they, like you guys mentioned, they're going to actually still meet their 900 to 1.1 billion guide. I thought for sure they were going to softball and go, oh well, because of build out, we have to lower our guidance.
Maybe the New Jersey location will come online soon. I mean,
yeah,
that's. Or maybe Charles is misleading them.
But yeah, overall, great quarter. Super pumped. It was, and I'm glad they answered a lot of questions. I feel like.
Yeah, that was great.
Yeah, they answered like at least 15 questions. It felt like, coming from being a Palantir investor, where they usually answer like 3 on a call and call it a day. This is it's a nice 180.
There are only 2 analysts on the Palantir call for the last 4 years, so it's not.
Mariana and Dan just answered the other one's asking questions, but yeah, great call.
Yeah, no, I agree. I mean, great call, great comments. Even on the Meta and the Microsoft deal, we've got a lot of information there going out of 25 into 2026. Q3 sold out, Q4 almost sold out. It's very difficult to say that this is, we're reaching a peak, right? This is still what, a $30 billion company or something like that. Yes, dilution is never great, but I mean, Manuel, you and I are Rocket Lab shareholders. I don't know if any of you are also Rocket Lab shareholders, but we've gone from $4 to $50 while also getting hit with dilution. I highly doubt that many people will be complaining about it because it just fuels the exponential growth ahead. It's pretty clear that Nebius is expected to grow extremely rapidly. It's not based on hope. They have the demand. They have to say no. If they could have said yes, they would have been making more money. So why wouldn't they look at ways to grow faster? Plus, when you look at Arkady, he's like, okay, how long is this call going to last? I want to get back to work. This dude just doesn't like earnings calls at all. He's like, yeah, okay, there is demand. We're working as fast as possible. We're doing this in a very prudent way. Can I get back to work right now? Thank you very much. And then it's like,
it's hilarious every time they pull it over. Arcady, can you answer this? And you just hear a massive sigh. Like, okay.
Oh, here we go.
Every single time, he's like, he just sighs and says, "We're so excited about our Meta deal." It's too funny every time. Every time.
I mean, we're clearly far from the peak because we now have Hamid. So we now have the last missing part of retail community.
Wait, what?
Yeah.
Hamid joined us. I saw, and Gab as well. He said that he opened a position, right? I'm not.
All right.
But he said this morning on the dip, trading at 3 times 2026 ARR.
We have the retail leader going to pump our bags.
I do hope that people know why they would buy Nebius and not just buy it because of.
No, yeah, of course, it was a joke.
Yeah, no, of course. But I'm just saying for people that are watching, hopefully you do know why you're buying this.
Please. Otherwise, when it's down 5%, I get dozens of DMs. Oh, why is my stonk not stonking? Please help. And it's just chill, guys. Know what you own. Please never buy something just because me, Sam, Neil, Nate, Amit, whoever bought like a stock. Otherwise, especially with this volatility, because the market has been just crazy. I mean, one day Nebius is at like under $100. The next day is at 120. The next day is at 105. And not only Nebius, like all these AI stocks.
Yeah.
Oh, I love that your dog is appearing on the background.
I know.
Mate.
She just keeps sitting like she's right here. She's just sitting there.
Guys, it looks like she's appearing it looks like she's appearing in a dream or something.
Yeah,
it does look like it's like the bubble, and you're thinking about her right now.
She's thinking about the farm you're going to buy with your.
Yeah, she's looking outside the window like, the more real estate we can buy.
Yeah. I'm interested to see how this is going to act during market hours because the Nasdaq is not looking good pre-market. I mean, we were up 2.5% yesterday, so can't really complain. But I'm interested to see how this is going to turn out during the day. If
any macro data that we got for this reaction, or just
I mean,
the day after a green day?
We were up like over 2% yesterday, and the VIX is at 18 still. Like the fact that the VIX is still in the high teens is just, we're going to have continued volatility. Like VIX needs to get crushed in order to see like this relaxed price action movement. But I am interested to, I don't know if you guys are looking because I was looking at the C earnings as well. I know obviously we're in a Nebius call, but I know some of you guys have Mercado Libre and a lot of e-commerce stuff. Just when I think about like just the massive expansion of a lot of emerging markets areas, it really shows you that it's not just in the US how much demand is growing, and obviously it's not just in Europe, but it's just everywhere, right? Like when you think about e-commerce expansion, like that's a lot of internet connectivity, also as well logistics movement. Like the degree of fear being put into the market that like we're literally on the brink of like a credit collapse is just I can't fathom it right now. Just seeing the degree of how much everything's accelerating, but also the profitability across the board with a lot of companies. Like there's always going to be a wall of worry for a bull market. Like if everyone is bullish, then the market can't go up anymore because everyone thinks it's going to go up, and that's exactly what happened in 1999 with the dot-com bubble, where everyone thought the market was never going to go down. And that's when it went down because everyone already bought. But now it's like you kind of need like this volatility in the market to keep it going higher, because then you have people who get out, get back in, they get more aggressive with the buying versus like, just like slowly buying shares. Like when you see a market up like 2%, there's always a buyer for every seller and vice versa. But when the buyers become more aggressive, where they start to like buy at the ask or above that, that's what pushes up stock prices. And that kind of like FOMO, like year-to-date end of performance chasing is what really brings, especially the leaders that are already doing well this year, up further. And I think that as we see the quarter unfold for a lot of companies, you really start to see like which companies are actually leaders and which ones are just riding the momentum. And in my opinion, I think Nebius is one of the leaders. I mean, it's just I don't want to say that I'm not pressed for any negativity on it. Like I have to look through it. Like clearly dilution was something, but like once you digest all of the earnings, because there's a lot, like I feel like I still need a lot more to go through here. It was a really good earnings for the company. Like I don't think that it was like a pump sort of thing. They're pumping the bags. Like you guys are saying, like Arcady just like, dude, let me get off this freaking call. Like, I'm not going to stay on here and like talk up our game and everything. It's like, no, we got work to do. All right. So like everyone get off the call. Like, come on, let's go. Like I admire the management in this company. It's really cool. And I think I like the fact that they're a lot of them are European, a lot of them from the roots of being in Eastern Europe. And I've been to Eastern Europe more than a few times. Like people out there are like very chill, like very humble, versus like the Silicon Valley people where it's like all hyped up, we want more funding and everything. Like it's completely different. And I don't want people to like take that like a negative aspect, that, oh, they're not trying to talk about the retail community, or they're not going to CMC talk about the retail community, which isn't bad at all. Like, I think what Alex Karp is like doing just fine, but like this management like does things completely different. And I admire that. I admire it.
The fact, I mean, you said it, the fact that we are trying to see, okay, what went wrong just shows that, okay, there are plenty of companies where, yes, maybe the hope or the price has gone up extremely high, the bar has been set extremely high to justify the price. And then when you look at Nebius, where, okay, we have gone up a lot, but based on a lot of fundamentals as well. Now we're looking at a quarter, we're like mind blown by it, and we need to look at what can we find on the negative side of things. Just goes to show it how well they're executing. There aren't that many companies like Nebius, and that's a good thing. Overall, there aren't that many world-class companies and world-class management teams out there anyways, because otherwise, I mean, any investment would have been quite easy. So yeah, I agree fully with what you just said.
Happy days.
Yeah, I mean, best case scenario is these types of results and the stock dips. Unless you have options, short-term options, then I guess it's not happy days.
Yeah.
Volatility is so high on it. Like, other than selling options, like I don't see any benefit for like buying premium for these companies. Like you need like a big move, and if we open flat, which is what we're going to open, like those options just get decimated.
Yeah, I mean.
All right. If you don't have anything to add, I'll let both of you Americans go get breakfast because it's probably getting quite late. Manuel, if you want to stay a little bit, we can talk about yesterday a Rocket Lab and maybe tomorrow's D local, and then I'll open the market. So I'll leave Sam's, Nate, and Manuel's links to YouTube, X in the chat and in the comment section as well. Thank you both for joining, and I guess we'll see each other 3 months from now with another mind-blowing quarter.
Awesome. Appreciate it, Neil.
Take
See you
care.
guys.
Appreciate you guys.
All right. So, Rocket Lab. What did you make of the quarter yesterday? I mean, we got a neutron delay. We didn't get a dip in the stock price as I would have wanted, and as many would have predicted, I guess.
Yeah, I think everyone was already expecting a delay because I mean, in the recent interviews Peter Beck had, and I mean, all these recent interventions, it was always like, yeah, we wanted to get it to the pad like in 2025, but it's always difficult, a rocket program, very complex. And I mean, it doesn't worry me a bit, as he's always saying, this is a multi-decade product, so it's not much different if it comes out. I mean, obviously we want Neutron to be like ready as soon as possible, but just like he said, he wants the first flight to be entirely successful, to get to orbit, not just to clear the pad, or like all the other space companies do. Like they blow up rockets, but they say it was successful just because they cleared the pad. I mean, that's not what success means to Rocket Lab. So I think, but just like you said, I was also surprised to see the stock price going up, even though I was already personally expecting a delay. I thought most people, I mean, especially on X, but I think Rocket Lab is becoming less and less on a percentage basis owned by retailers, and like now much more owned by institutions, especially throughout the past few quarters. I mean, this 10X didn't come without institutions getting in, obviously. And actually, Rocket Lab got like a new wave of upgrades this morning. So clearly, analysts are not worried about the timeline for Neutron either. And the rest, I mean, just execution across all fronts. I mean, Electron, the prices for Electron and ACE continue to go up. The cost per launch continues to go down. Gross margins are increasing every single quarter. The space system segment is also strong. I mean, we don't have many news on the SDA contracts or whatsoever because of the government shutdown, but they seem pretty confident that they're going to get the third tranche of the SDA contract. So overall, I think there's nothing huge to point. Just continue the execution. I never worried that much about Rocket Lab's quarterly reports, to be honest. We not only but mostly care about Neutron, but in this case, I was surprised that the stock didn't dip because all what the market cares is Neutron. But I can see why, because in the end, we're like 1 month and a half away from the first quarter of next year. So it has never been closer, even though it was delayed. It has never been closer.
Yeah, no, I agree. I'll ask. Apparently, you have some HRO subs investors and your Substack subscribers here as well. I guess they reported yesterday, but I agree with you. Like with Rocket Lab, I mean, I guess it helps that the stock is down or was down 30% from their highs going into the earnings report to not have such a big overreaction. It also helps that Electron and Haste are all doing very, very well for now, supporting the core business. And then again, I mean, okay, big deal. It's Q1 2026. I mean, like Peter Beck says every single time, we're not just going to launch it for the sake of launching it and not really get extra data or data that we couldn't get without blowing up a rocket that cost us quite a lot of money to build. So I agree. I mean, waiting another month, 2 months or so to actually have a Neutron launch that reaches orbit and get valuable data is worth the wait. And then after that first launch, we calculate 12 months out and see how many actual revenue generating Neutron launches they can get. Because some people thought it was still going to be 2026, but it's really 12 months that you start counting after the first test launch. Of course, then we'll see what happens if they feel comfortable, if they have enough data, and all of that. But the Rocket Lab, Nebius, I guess D-Local is one we'll talk about a bit later. It's one of those companies you own because one, market cap wise, it was quite small when we got in. The potential was quite huge. The team is incredible, and so we're not really that worried on a quarter to quarter basis. But we'll talk a bit about the local in a second after. Maybe you want to share something about Harrow. I'm pretty sure you're going to cover that in your Substack as well.
Yeah, I will. I mean, they missed revenue, beat earnings. I still need to listen to the earnings call because the results were yesterday, but the call was during the Nebius one, so I hadn't had time to review it. I mean, at some point the stock was down like 16% in the after hours trading, and now does it stay there?
No, it's down only 2.
Yeah, I think it was a huge overreaction. I mean, the guidance was at least $280 million this year. They lowered to between 270 and 280. There was a one-off event that helped to lower that was part of the reason why they lowered the guidance. But overall, I don't like that the CEO is constantly overly optimistic when giving guidance. He's kind of a bit of a salesman. But considering the valuation, I think it was more than discounted, the slight miss. They missed revenue by 2% or 3%. And I mean, the stock is trading at $1.2 billion right now. I don't consider the target they have for 2027 as guaranteed, like whatsoever. As I said, the CEO is usually a bit overly optimistic, but the multiples are really, really low. This is not a company. If we had because I thought that the CEO was learning from past mistakes when it comes to guidance, but clearly is not, or maybe it was because of the one-off event, but I can't really trust them like I trust, for instance, Nebius, Rocket Lab, or the locals management teams. So I will probably not make it one of my largest positions, because I was honestly considering it based on the valuation. I think it's one of the best opportunities in the market right now. But because of my lack of complete trust in the management team, not in terms of executing on the mission over the long term, because in the end, even though they're missing a bit the expectations, they're missing just because they set like sky high expectations, but just missing by a few percentage points is still a good execution, in my opinion. And I still think that there are meaningful catalysts, and I mean, as I said, it's too cheap to ignore, in my opinion. You should take a look at it, but it's not the type of business that you get super excited about. It's, as I said, the central focus here for my thesis is the valuation, because they have a portfolio of products, and the playbook is always the same. Now, as soon as they release new products, they already have the infrastructure in place to make them ramp up. It's not like they are one of those biotech companies that spend huge amounts of R&D to then hopefully get a drug. They have like a more conservative approach on that side. They acquire drugs that are underperforming because of a particular reason that they think they can reverse or something like that. It's already green now. Crazy. But yeah, overall, I think it was a huge overreaction. I'm not really happy, because I was really wanting to see a great quarter to buy a lot more and make it potentially one of my top positions. It's still a fairly relevant position in my portfolio, and I might add more, but I'm not probably going to buy like a lot more shares as I was considering, just because of this problem with the management team. I still think the CEO is the right person for the job, because this is not like, as I explained in my deep dive, this is not the type of company where you want, for instance, with Rocket Lab, Peter Beck is a wonderful engineer, and it makes all the difference in the development of the rockets and everything on a more technical aspect. But the CEO, the problem is that he's a salesman, but we want salesmen in this type of business, because it's all about ramping up the sales of products that are already FDA approved and developed, and that are indeed better than the other products on the market. At least this is not only according to the CEO, otherwise I wouldn't 100% believe it, but according to experts, especially the main growth driver right now, which is an eye drop product, which is clearly better than all the other ones in the market. That's why they doubled market share in 2 quarters. So I think it's good to have a salesman, but I think the role of salesman must be skewed towards selling the product and not towards shareholders. And that's my main problem with him. Because I mean, you can be a great salesman and still be transparent to your shareholders and not set sky high expectations. I always prefer the under promise over deliver guys. This is kind of an inverse, but I don't think it's a reason to panic, because the reason why he misses the targets is because he makes targets too high. So in the end, it's not because of poor execution, it's because of a bad management of expectations of shareholders, which is something that I think it's very important for the stock price itself. And for instance, when I was a shareholder of HIMS, it's something that Andrew was always doing very well since the IPO. Now, not so good in my opinion, but that's another case. But I think it's very important for the stock price, regardless of, obviously, we think if execution continues, the stock price will follow in the long term. But in the short term, I think the way the management team deals with expectations and how what shareholders should expect, it always ends up influencing the stock price. Because if he had the estimates for this year like at 270 million plus instead of 280 million plus, And yesterday the guidance were a bit, even though the business would still be exactly the same, because the expectations were different, the stock would have reacted different. So in the end, my thesis remains unchanged, but I was considering to buy a lot more shares, and now I'm still reflecting on what I'm going to do, but I'm definitely not going to sell or trim. But I might buy a bit more still, but I still need to listen to the earnings call, basically, because maybe they had good reasons for the small miss. I don't know. I still really need to read everything, not to read everything because I already read everything, but to essentially listen to the earnings call.
Okay, no, fair enough. I guess. I mean, by the way, the stock is up 4% after you. Now that you talk about it,
it's up 8%. No,
8%. Maybe it's moving up so fast that it's up 8%. It's back at 37. Back at $37 right now. So yeah, the market is open. Everyone, ding, 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 bing, bing, bong. The market is open. I guess Harrow has been a bit of the same for you as Pagaya, buying it purely valuation-wise. You like the business, but valuation-wise, it makes sense for you for a 12 to 24 months or maybe 18 months hold. But I did read that for Pagaya, especially after yesterday, you're starting to maybe switch towards, actually, I like this business quite a lot. The execution is quite good, and maybe it might stay in the portfolio if, of course, the execution continues like that. But I agree. I mean, I don't follow Harrow that much, but I agree that, a CEO's job is definitely, to lead the company to greater success, but also have realistic expectations, not set the bar too high for the sake of setting the bar too high and then missing it. Revenue-wise, didn't miss by that much, but you would still like a captain of the ship to not overestimate how much left or right he's supposed to go.
Yeah, Pagaya. I think Pagaya is a bit different, even though it's, as you said, mainly from a valuation perspective. I think the differences are, first, the last quarters. I mean, the execution has been brilliant for Pagaya. They really underpromise and overdeliver. I think it's clear when they issue guidance that they're going to beat it. At least, for instance, the quarterly one, the guidance they gave now for the fourth quarter, I mean, in my opinion, it looks clearly sandbagged. So it's different in that aspect, but it's as you said, it's similar in the aspect of my crucial point is valuation and an expectation that a re-rating will come in the next 12, 24, 36 months. But in terms of time frame, the reason why I said that initially Pagaya was, and I still consider it 12 to 24 months holding, is because I don't like to be exposed to credit cycles. Because I mean, they are supposedly now building for through the cycles numbers, and like they're very conservative now in the underwriting, like compared to Upstart and other companies. They could have been growing more in recent quarters, but they prefer to stay conservative, which is nice. But still, they will inevitably suffer once the credit cycle turns. But I don't see that happening soon because interest rates are going down. It's a clear tailwind. I mean, we have huge, scary headlines about consumer credit deterioration and all that. But the reality is that companies like Pagaya and its peers are reporting great results. Upstart had lowered the revenue guidance, but it was because of a problem on its model. So it was firm specific and not related to the industry itself. So I think that at 5 times EBITDA Pagaya right now, and EBITDA of this year, when you compare it to Upstart, which in my opinion is an inferior company in terms of business model, which might bring more benefits when the credit conditions are favorable, but it's much more risky when the tide turns. And the recent execution has been way better in Pagaya as well. So I think it doesn't make sense that it trades at less than or at 1/3 of Upstart's multiples. And this is after Pagaya is like up 200% year to date, and Upstart is down 30 or 40% year to date. So the guys that saw these last year and bought Pagaya in single digits have already multi-bagger returns and are still holding a very cheap company. So I think the difference is this, because Arrow is not really dependent on credit cycles. So I base my investment on a re-rating on the short to medium term. But I could, if they have a clear pipeline to continue growing through 2028, 2029, 2030, if all goes well. They have other products coming online every year. So it could even be a longer term holding if management continues to execute or tries to do a better job in managing everything. So yes, the similar part is my focus on valuation, but the differences are really about the credit cycle,
the sector
influence. It's not that I don't trust Pagaya, because the last few quarters were amazing, and the new products they're rolling out, and they're deepening more and more into the partners. So I strongly believe they might build a sustainable business for the long term, but it's not really a sector I like to be very exposed, like SoFi and all those companies that essentially are related to loans and credit risk. It's not my cup of tea, let's say, but I couldn't ignore the valuation, because Pagaya is really, it doesn't make sense in my opinion. And I was a bit worried when it was down like 40 to almost 50% from all-time highs because of all the bad headlines. But again, we always need to look at contexts. Pagaya was at all-time high. It started to go down because the largest shareholder, which is Viola Investments Group, started to sell part of its position because one or more of its funds was liquidating, so they had to return capital to shareholders, and so that's why we had a huge selling pressure. When you see that candle when they reported earnings, they started to sell, not that one, in the other quarter.
The 20+%.
It was up 30% and closed like flat or red, and most of that selling pressure, at least that's what we found, was because of the selling pressure from Viola. Then the buying pressure came and it went all the way up to the 40s, and I mean, it was everything going well, and then the scary headlines with that note from BTIG about Upstart that was corrected in the following day. And everyone started to be afraid of the credit conditions and delinquency rates. And I mean, when I saw that note, I was actually worried as well, because we had no indications about that, and suddenly Upstart is like the delinquency rates doubled from a month to another. I mean, it was quite scary. So I understood the movement, but then they corrected and the downward pressure continued. Then iBeta names started to correct, all of them. So it was kind of a cocktail of events unrelated to the company's fundamentals that led to a massive drawdown. And I mean, that's why the stock reacted so positively yesterday. And I think it should be even higher by now. It's really stupidly cheap, in my opinion.
Yeah, I mean, yesterday, when it was up 20% pre-market, I was like, yeah, it's up 20%, but I've seen this story play out before. It would still be up for the day, but probably way less, which is exactly what happened. I think we closed out yesterday 13%. Today, we're up another 3.8%. Fine. You've compared it to Upstart. I mean, Upstart, you said trading at 16 times EBITDA or Pro, something like that. It's either Upstart multiples have to come down or Pagaya multiples have to come up, or maybe both. Both can be true here as well. But yeah, the stock did go down 50% from the all-time highs based on what it seems right now, external issues, non-company related issues. And we've seen that across the board with plenty of other companies. Just because one company in that sector does badly does not mean that the whole sector is screwed and every company is affected by it. Nope. Quality companies are quality companies for a reason. They should be trading at a premium. In this case, Pagaya is the quality company that is trading at a discount compared to an Upstart, which clearly does not deserve the premium that it's getting from the market right now. talking about a company that maybe does deserve a higher premium is dLocal, is a company that reports tomorrow. dLocal is also one of those companies, right? Last quarter, amazing quarter, stock did go up quite significantly. It didn't really take that long until we see it go down again. Okay, there were some also external factors, macro, Argentina, come into play. But it seems like it's one of those names where, okay, every quarter it will prove to the market that it is fast growing, already profitable, an undervalued company. Because people forget this is a company with, what is it, $50 billion in TPV, I believe, something like that, last quarter. Around that number. Market cap was still under 5 billion or around that number. Yes, it's true that it is exposed to the global south, to emerging markets, that there are high fluctuations in some of those markets. We understand that, but it is one of those few companies, smaller market cap, that is growing fast and profitable, which I don't think there are many companies like this out there. And you get, of course, Pedro Arndt, ex-CFO of Mercado Libre, now CEO of dLocal. Honestly, if he was not CEO, I don't think, first of all, I don't think that dLocal would have still be a standalone company. I think somebody would have bought it out. Like him coming in, creating a very good team around him is also one of the main reasons where I'm like, you know what? This is also one of those names where I sleep well at night. I know that they're executing. Stock-wise, it's been quite cheap for quite a while. Yes, it is finally above that $10 or sub $10 mark for the last 3 quarters, for the last 3 months. But I do feel that this story will just continue to go up and to the right as they continue to execute. They're expanding their product base. They're expanding their, markets as well. What are your expectations for tomorrow? I'm not even talking about stock reaction, because that can go both ways, especially depending on what the market is feeling on that day, but purely business-wise.
I think dLocal is a bit tricky to build expectations on a quarterly basis because of the exposure to so many currencies. So the Forex impact is always takes its role when it comes to beating or missing expectations. But after the last quarter, it's hard not to be optimistic because they absolutely crushed on every single metric, and it was a blowout quarter. So, and I mean, they raised the guidance by a significant margin. So, and they were already into not half, but probably almost half of this quarter. So I think the quarter will be strong. I'm not sure if we're going to beat estimates, but I would bet on that, especially after the last quarter, as I said. But overall, this is not a company I worry too much about the quarterly results, especially as you said, because of Pedro. I really trust him. Obviously, I don't blindly trust him, but it's simply great to have a leader where you know he knows what he's doing. And in this case, I think he's clearly the right person for the job, and the differences are clear ever since he joined the company. This is a company that I see myself holding for many years. The runaway is just immense. Like, they can continue to compound at 40-50% year over year, the TPV, for many years. This is a $1 trillion market. There will be competition. I got some questions about a private company that was supposedly capturing market share in the payments processing across Latin America and emerging markets overall. I mean, this is not a winner takes it all market. It's just huge. The last quarter, the NRR was like 145% or something like that. So clearly the merchants that are already embedded in dLocal are spending more and are investing more in emerging markets. And Pedro said that with all this tariff drama, like, companies are increasingly open to investing more in emerging markets. And and I mean, they're in 40 plus emerging markets. So if one underperforms, there will be another one to outperform. So overall, I think this is definitely not a buy and forget stock, but it's a company that I feel very comfortable owning, and I don't freak out thinking about the quarterly results. I'm not sure what to expect tomorrow, because I think the dollar has been gaining some value over some currencies. But in the end, it will depend on so many currencies that you can't really draw much conclusions from that. Because I think if you look at the Mexican peso, I think it's gaining value to the dollar, which is positive for the local. But then there are other currencies that are losing. So again, it's difficult to think on a quarterly basis. But as long as they reiterate the guidance, I mean, I don't think we have any reasons to worry about. But yeah, as you said, I'm optimistic because, and as I said, sorry, I'm optimistic because of the last quarter, which was, I was expecting a bit, but it was a monster quarter, like way above what I was expecting.
Yeah, I mean, this is the, not even the quarter guide. This is the 2025 guidance for TPV, revenue, gross profit, adjusted EBITDA. Their expectations is to meet at least upper, if not above upper guidance. And I mean, the growth rates here there are insane. TPV, new range is 40 to 50% year-over-year growth. Revenue 30 to 40. Gross profit, basically, let's call it 32% or so year-over-year growth. Adjusted EBITDA, midpoint 45% year-over-year growth. Yes, like you said, since they are in multiple emerging markets, but they're expanding, so their exposure, their diversification is going to be a positive thing in the future as they grow in more and more markets. Because previously, right, if Egypt, let's say, performed badly, then it would have impacted their quarter more than in the future as they grow into multiple other markets. But it seems like they know what they're doing. They know the risks. They know how to move. It's a very interesting space. Yes, there are competitors. There are competitors in every industry out there. But what makes a good company stand out is execution, is great management, and an excellent product with the local. Right, previously stock went down heavily, right, when gross profit margin went down, but gross profit dollars went down as well. Then we've seen gross profit dollar rebound, followed by continuous gross profit margin expansion. Take rate was the big talking point, right? Oh, take rate will come down. Yeah, but they say take rate will come down, but TPV growth is expected to grow and accelerate, and this is exactly what we're seeing. Didn't even take that long to see the results. It's exactly what we're seeing right now. And so yeah, again, price-wise, stock price-wise, I don't know what will happen tomorrow. I don't know what the implied move is, or even the short interest. I don't know, but I do believe that the management knows what they're doing, and so that's more than enough for me. Plus, what we've been seeing, especially last quarter, is the execution is there. They're growing with their customers. The customers are willing to actually pay more to use the local. So I am quite happy with the performance. It's been actually a very good weeks for the companies that I think we own, companies that you own as well. Performance-wise, business performance, the stocks, they can do whatever, but business performance, I think it has been quite a good earnings season. All in all, yes, Nebius is now down 4%. CoreWeave is down 11%. Iron is down 6%. Applied Digital is down 9%. It's quite interesting that Iron is down more than Nebius right now. I believe one guy posted about Iron being up while the others are down. That's the key differentiator. Well, I guess the tables have turned.
Poor guy.
But yeah, all in all, how's you actually, before we end, how's your earnings season been? Because I think it's almost over for most of us.
I mean, last week I only had ClearPoint, and this week I have all my holdings. Like I own 7 companies, and I have 6 reporting this week. Yesterday I had Pagaya, it was great. I had Rocket Lab, it was as expected. I had Arrow, which, I mean, initially I thought it was the worst, but it's now up 8%. So stock wise, it's like one of the best ones. But in general, the 3-1. And now Nebius, of course. So the 4 reports I had so far, nothing has changed from a thesis perspective, which is ultimately what matters to me. Yes, it's nice to see Pagaya going up after the huge drawdown that was like not related with the fundamentals, but it's up 15% after the report, which is nothing compared to what it still needs to recover. Rocket Lab, I don't really pay much attention to the stock price. Obviously it influences quite a lot my returns, but I don't plan to sell or buy more Rocket Lab anytime soon. I just keep my position. I actually have it in a different brokerage. I literally don't look at it. Arrow, I was expecting a bit more, as I said, but still enough to maintain the thesis. And the stock is pumping in now almost 10% now. So the market is, as I said, I think this reaction is essentially because the price, look, that drawdown from $50 to $30, it was not justified by anything. In the meantime, they had an investor day, which was amazing. So I think it was already more than discounting a small miss, and that's why I think it's going up. But it's crazy that yesterday it was down
14, 16, yeah,
in the after hours, and now it's up 9%. If you see like last earnings, look at that candle. It was also something crazy. It was down like 20% and closed green, like up 10.
Just it's a $10 difference.
Yeah.
From top to bottom, insane.
But overall, I'm pleased so far. I still have the local, and then and today is what? Today
Tuesday, 11th.
Tuesday. So yeah, I only have the local now and Twists. I feel like I'm forgetting. Twist is my smallest position. I opened it recently.
All right. For those wondering with Iron, because I've seen some people or Iron or Core or Nebius complaining, it always goes down. It doesn't really always goes down. It's been literally, it was at all-time highs a week ago. It's like a week ago at all-time highs. It's up 600% or so over the last couple of months. CoreWeave has been one day that has been a bit, but it's the biggest one out there. It's there was also this whole Core Scientific acquisition thing, so that put some more pressure on the stock.
Yeah. And the IPO
Nebius.
craziness.
Exactly. Also the IPO. And then we have Nebius. I don't know who's complaining about Nebius, because literally this thing is still up from June, not even from April. It's still up more than double from June.
Yeah.
So
no crying in the casino.
Exactly. Neil, sell all these betas and buy Palantir and Nvidia and thank me later. You cannot tell me that Palantir is not an overvalued company right now. Like, why would I? And it's also, I wouldn't say as high as a beta as those names, but I think Palantir is also one heck of a volatile stock right now. Nvidia is something else, but I'm not selling any of these names. But I will thank you maybe later for whatever else you want. But yeah, okay. All in all, good earnings season, good comments, good results by Nebius as well. I think the price will do whatever it will do. Execution here is quite good, I would say. 2026 is going to turn out to be quite an interesting year. I think with Nebius, with that insane ARR. And yeah, we'll see what happens. So I'll leave your YouTube and X link in the pinned comments. Same for Nate and Sam as well. Thank you for joining, by the way. Really appreciate that. Thank you all for listening and joining us. And I guess we'll see each other. In the next one. Bye bye.